Okay, welcome everyone to a practical example that we're going to be going through, quite a thorough practical example, and hopefully whatever I've gone through with regards to the process of how we actually prepare for these central bank event-driven risks will kind of come together now when we actually look through an example a little bit more thoroughly. So with the example we're looking at and the context of where we are right now, it's currently the 22nd of January, 2015, and we're looking at the ECB event that's taking place on this specific day. Now, as we went through before, I kind of took you through how we um, prepare for each part of this meeting or any sort of meeting in general. We went through the general kind of way we prep for it. And so I'm going to go through the prep guidelines and then after I've gone through this prep, we'll show you the practical aspect of how it's traded on the price ladder and how it kind of how it panned out really. So let's just see from a practical perspective how this has gone down. So if we start off with the backdrop, so we did mention this before. Before we start with anything, you want to make sure you're going through the backdrop, understanding um, what the context of this certain central bank meeting is and what it's about. And we always start off with saying, okay, what is the ECB in a nutshell? What is this ECB event in a nutshell? So we highlight January 22nd, we've got a rate announcement at 12:45 and then a press conference. Um, the rhetoric overall has shifted very clearly to favor sovereign QE, and we'll take a look at some of those central bank speakers. But very much the rhetoric has shifted over the last few months towards that, so that's something we're already expecting. And the majority view is for at least 500 billion of QE. So this basically the thesis of this ECB is QE or not. So we've come to the crunch point, and it's right now the ECB is having to make a decision whether they're going to embark on a quantitative easing program. But so far from the rhetoric that they've said, we're expecting that. So sovereign bond QE and we're expecting it for it to be announced, and there could be a possible delay in the program details. So they could just announce it and possibly give us a delay. We don't know the structure or how they're going to deliver this to us, but the majority are expecting this. There's a range of view on how they can actually design the QE program and also risk sharing. And then there's the Greek political uncertainty unlikely to influence a QE decision. And there was already, at the time, there was some Greek political uncertainty. But very much the risk sharing is something that's got a potential focus. So the risk sharing of basically the potential losses, as we mentioned here, that's something we're going to be looking at a little bit more in depth. So let's take a look. Like we said, we like to, after we've gone through the backdrop, we want to start highlighting, okay, well, what are the key data developments? What are the key data developments that the ECB might have been looking at coming into this meeting? You know, how they're basing the decision. Obviously, they want to look at the data. Most central banks are data dependent, and they want to see if the data warrants a decision like that. So if we look, let's say, for example, at the European PMI manufacturing, the services PMI, and then of course the most important of all, the inflation. Let's just see how those performed over the last few months so we can kind of ascertain whether it's time to do something or not. So taking a look at the manufacturing PMI, you can see very, very clearly since the beginning of 2014, we've been pretty much in a downward trend. So the Purchasing Managers Index is saying, well, listen, guys, manufacturing-wise in the Eurozone, we're not looking too good. In fact, we're literally since October, around here, you can see the first of, sorry, the 10th of January there, you can see, or sorry, the 1st of October. It seems like these dates are a little bit flimsy. The 1st of October 2014 until where we are right now, we've basically seen the PMI manufacturing just above the 50 mark. Now remember, anything greater than 50 means there's expansion. Anything less than 50, 48, 49, 50, 45, in those regions, we're talking about contraction. So this is expansion, this is contraction. So we're basically on the brink of possibly moving into contraction. We're still expansionary, but we've definitely become a lot more subdued. And so that data has stayed relatively low. We have noticed though in the last one we had a small pickup, so that could be something that they might take into consideration. Now, taking a look at the PMI services, we saw since 2014 we did have a pretty nice little move to the upside till about July of 2014 when we had the highest print, which was above 54. And then ever since then, again, we've seen a downward spiral there. Again, moving. We're very subdued. You could see these last two prints were quite subdued. Again, a nice little pickup there in the last one that we saw at the beginning of 2015, but nonetheless, we're still hovering very, very close to the 50 mark, which is not a comfortable situation, obviously, if you're looking from an economic growth perspective. So next, we'll take a look at the most important, which is inflation. Inflation is really what has basically sparked the ECB to look into this, and particularly inflation expectations. But just purely on the annual change of CPI in the Eurozone, you can see we're now printing a deflationary print, or at least we're in disinflation. It's not necessarily deflation as of yet, but at the minute, there's no pickup in inflation. We're actually seeing a diminished inflation print. So from all these positive readings, now our reading has firmly gone negative. That's something, this is something the ECB is definitely looking at, and from a pricing perspective, is probably why we're seeing such aggressive rhetoric and pricing in of a potential QE announcement. So we've taken a look at the data, the most important data. Let's take a look now at the key central bank speakers and what they've said coming into this event. And it's good. It's very important to understand how they move the market and what it is that they've said that's moved the market. So if you take a look more or less, and you can just skim through, you can read this in your own time, obviously, but if you just skim through the main ones, the big guys, Draghi obviously being the most important one, you could see his most recent, or last two most recent comments, January 2nd and January 14th. On January 2nd, he said, "We are making technical preparations to alter the size, pace, and composition of our measures in early 2015. Should it be necessary to further address risk of too long period of low inflation, the Governing Council agrees unanimously on that." So this is already saying we're already making technical preparations. That's a very big hint that they're looking very firmly into something. The ECB is ready to buy government bonds. That is a pretty big clue that they're ready to do something. All government council members determined to meet mandate, although there are different views on how, need expansive monetary policy to achieve price stability. So you could see there's a very rich conversation of expansive monetary policy. QE is basically is firmly expected because if Draghi's saying this, we know this is going to happen, and that came out just about a week ago. Constancio, he's the VP, the exec and VP. He said QE is nothing more than a traditional open market operation. Central bank's option to buy or sell securities, even government bonds, in the secondary market in order to control the monetary supply. This is perfectly legal, and we don't exclude what is legal. So he's basically playing down the idea of QE, saying this is very, very much a traditional open market operation. So he's not trying to make it sound too crazy. We're going to do this because it seems like the right thing to do. And again, possible that current measures will not be enough. Only market with big enough size may be sovereign bonds. So we know that sovereign bond QE is most probably on the way. So just from the comments here, you can see all of the guys that are for QE are very much boasting about it, and they're very much on in the camp of let's get this going. Then the against on the Governing Council, we've got probably the most important, the Bundesbank's Weidmann. He's a hawk from Germany. Given the rather modest and uncertain impact of broad QE package, together with risks and side effects it could bring, and the unclear need for it as present, I would greet such a package with skepticism at this time. So even someone that's against it, I would greet it. So he would greet the package, but with skepticism. So you could see even the guys that are against it more or less are talking about this, and they're not completely on the other side of the fence where they're saying there's no way. Weidmann, which is a notorious hawk, um, and the president of the Bundesbank is coming along and saying that kind of comment. Then you've got the ECB's Mersch, also a hawk. ECB should allow current stimulus measures to take effect first, and then potential new measures. And then potential new measures must be analyzed in advance for effectiveness and conformity to ECB mandate. So again, not possibly on the fence this one, but I wouldn't say they're completely against it. You see the neutral and undecided ones, Core, which is known to be a dove. If we want to do more, we obviously have to reach out to market segments where there is more liquidity, and that is why the government bond market is in the baseline option, which doesn't necessarily mean we would only buy government bonds. So again, very rich conversation of QE. So overall, you guys get the idea. When you're looking through what the central bankers have said, it's very important just to read through what they've said, understand why they're saying such things, where their stances are, if they're hawks, if they're doves, what their position is on the board. Are they strong? Are they vice president? Are they president? Peter Pratt, for example, this guy, he basically puts forward any ideas on how to actually execute, um, you know, such QE programs. Uh, so anything that he says, possible that current measures will not be enough. Someone that says that, and he's a very influential member of the board, you know it gives more credibility towards the idea of QE. So you get the idea when you're going into a central bank meeting, just make sure you read through these comments by the central bankers, because they're the ones taking decisions. If you have their insights here, why read an article when you can just look back? Um, you can just look back on what they've said word for word and see what their sentiments like, how they feel about this potential stimulus measure or whatever it may be coming into that event. So that is, oops, that is more or less what we would cover from the central bank aspect of the central bank speakers, sorry, and then we'll try to take a look at the retail expectations, see what the articles are out there and what the rest of the market's kind of reading coming into this. Obviously, this is a fairly well speculative, or at least an ECB meeting or any sort of central bank meeting that many market participants are already looking at already. So in that respect, the retail market's probably as close to informed as the institutional side, because there is so much expectation for action. The articles and the news presses are always on it. It's usually when you get into central bank meetings where there's less expectations, where the retail markets has a wider gap with what the institutions know, because the institutions um, understand the market pricing, and there's the market colors a little bit more advanced at that point. So you'll find the retail expectations in this case are actually probably very much close to what the institutions are thinking anyway. But in any case, let's go through one of the Financial Times articles, which was titled Eurozone QE Set to Arrive, but with Conditions. So you could already see very much expecting QE set to arrive, but conditions. What are these conditions? So if you just skim through, European Central Bank will this week set out plans for an ambitious program of sovereign bond buying. And then as you move on through the article, you can see here we go. Placing the burden for losses on the shoulders of national central banks is unlikely to win Mr. Draghi's support for Jens Weidmann, the Bundesbank president and governing council member, who said QE without national responsibility for losses would contravene EU law. So you can see very clearly the hawks are probably pushing for. So the hawks are probably pushing for less risk sharing, and the doves just want all-out risk sharing. And when you say risk sharing, I mean the credit losses on any potential bonds is shared amongst the euro system, the national central banks, and basically in that respect the taxpayers of that country as well. So it comes down to how are they going to share this risk? Is it going to be a 50-50 scenario where 50% is fully shared by the Eurosystem and the other 50% is taken on only by um, the ECB, for example? That is a scenario. That is one of the main aspects that we need to take in consideration when we're trading, because that's going to obviously affect the markets that we're trading. If you look further down, you can see Klaas Knot, head of the Dutch Central Bank, who's among the council skeptics on the merits of bond buying, has signaled he would be prepared to switch sides if national central banks agree to buy their own debt. So there's a question: is it the ECB buying outright the bonds, or are the nations buying their own bonds and taking the risk on their own for their losses? So that's already a scenario. That's something we got to keep in mind when we're building our scenario analysis. Okay, so let's move over. Move over to the next part of the article, where it says the plan that would appease German taxpayers' fears that would be punished for the view that other member states view as other member states profligacy. The expectation that Greece's left-wing city. Okay, we don't need to know that. So overall, you can see, if you get the idea, that there's a definite discussion amongst the ECB members and in the marketplace of how the ECB, if they embark on a QE program, how are they going to share the risk of buying these bonds? Are they buying them outright, or is it the national central banks? So if you read through this article, you can get the idea that that's one of the main things that the retail market is already aware of, and most market participants are already aware of. Something that we want to know, a piece of information that we want to know when it comes to it. Here's another article that we had from Reuters: ECB QE, what markets expect and what it might mean. So let's just see if we can. So financial markets are primed for Europeans to launch a quantitative easing program on Thursday in an attempt to receive moribund Eurozone economy and inflation. Revive the moribund Eurozone economy and inflation, yeah. So what are the considerations? What are the possible consequences? You can see the key factors to watch. So one thing to watch: size. So that's one thing we already know. We want to know what the size of it is. How much new money will the ECB print? Money market traders polled by Reuters expect 600 billion euro sovereign bond buying program. So we've seen 500, we've seen 600. A day before the meeting, media reports said the ECB would buy bonds worth 50 billion euros a month. So we've already seen a report coming into today that they would be willing to buy 50 billion euros a month, with one saying purchases would last a year. So now we know overall expectations of the market are probably baked in for 50 bill a month for 1 year. So at 50 bill a month for 1 year, that would make 60 or 600 billion rather. That's where we get that figure. And then you can move on further where it says, if true, these suggest total purchases of between 500 billion and just over 1 trillion euros. 500 billion will be slightly disappointing. So we've seen the one key thing here is that it says, so purchases would last a year and another from March to the end of 2016. So we're overall looking at an expectation of between 500 and a trillion euros. The important thing is to understand the pace, understand how much they're doing, and until when. So we want to know how much, until when. These are questions we're going to have to ask ourselves during the meeting, because they might not tell us flat out we're going to be doing 500 billion worth of QE. They might tell us a pace, and they might tell us to when. Then the next thing as we move along, again, pricing. You can see economists polled by Reuters put the probability announcement of QE will come this week at a median of 70%. So what they're saying is, from according to a Reuters poll, is a 70% chance that this is already priced in. So if we get the announcement, we still have another 30% of pricing in coming in. Slightly less than 90% money market traders are pricing in yields on top-rated Eurozone government bonds with maturities up to 6 years have fallen below zero as investors have snapped up paper and hope that they will be able to sell it to central bank for a profit. You already see coming into the meeting, many people have already speculated this. They're not waiting for the ECB to say it. They've already piled in. So the money market traders are telling us 90% chance. So we've got the Reuters poll telling us 70%, and the money market traders are telling us 90%. So one's telling us this is pretty much fully priced in, and the other one's telling us, well, almost. We've got a little bit more to go. So very important to distinguish between the two, because the money market traders are probably going to understand a lot more than just a Reuters poll of economists. That's one thing you have to keep in mind and bear in mind in going into any central bank meeting. So let's move over to positioning. Investors have snapped up here. This is basically the same exact thing we read before. Risk sharing. There is major uncertainty over how the scheme will work, with the main focus on whether individual central banks will buy their own country's bonds and bear the brunt of credit risk, in a nod to German moral hazard concerns. This could prompt investors to cut exposure to peripheral Eurozone bonds, and boost demand for top-rated, more liquid assets. Peripheral bond yields are likely to rise from their record lows and widen their premium to bunds. So obviously what this is saying is if we get high risk sharing, we should see the spread between bunds and BTPs, for example, to tighten. So basically BTPs will probably outperform the bunds, and in such a way we get the yield spread actually tightening. And what it's saying here is, in the converse scenario, if we get low risk sharing, you probably see the core outperform and periph underperform, and thus you probably see the spreads widen, as it says here. So that's more or less what we would expect anyway. So that's something that is quite important. Exclusion, this is talking about Greek bonds, but since we don't trade Greek bonds and we don't trade any of the Greek markets, it's not something we're going to look at. But it's basically saying whether the ECB are going to look to buy junk-rated Greek bonds or not, or opt to not do that. So let's see here. We've gone through the backdrop. The next bit we're going to go through, like we've been through our process, is the market pricing. Now, with regard to market pricing, for this ECB event, looking at the short-term interest rates is not actually a way to go about it, because essentially with all the other stimulus programs, they're buying ABS, they've had the LTROs and the TLTROs, targeted LTROs. There's a lot of excess liquidity into the curve already, so pricing is very difficult to ascertain. And we're already seeing yields on those short-term interest rates that were basically either zero or below zero. So very, very difficult to ascertain in this case scenario. But if you follow what Deutsche Bank and Morgan Stanley say, their current market pricing is consistent with 200 to 400 billion balance sheet expansion over 1 year, which is well short of the ECB's expansion of 1 trillion. So basically what that's saying is the markets, in this case, it's actually telling us that it's really not all that priced in. So even though we're seeing money market traders in the retail article telling us, well, hold on guys, we've got almost 70 to 90% priced in for QE. Yes, we do have priced in for QE, but it's how much QE and to what extent. And what this is telling us is more specifically 200 to 400 billion is priced in. Basically, if we get a 400 to 500 billion balance sheet expansion, it's going to be quite disappointing. This very much shows us that, because the ECB told us that they want to expand their balance sheet to 1 trillion. In order to do that, they'd have to buy at least 700 billion, 700 billion. So anything between 6 to 700 billion is probably something that's going to be um, it's still going to be quite exciting for the market, but not the ultimate scenario. Anything closer to 1 trillion mark and above is going to get the market very, very, very excited. If we look at the Euribor script, the strip, um, that has priced in a very small probability of approximately 2.4 basis point cut in refi rate. But obviously, taking that into account, there's probably extra liquidity being priced into the curve, and as such, you're getting um, the Euribor is trading higher in price and thus lower in yield, which is giving us a potential pricing for a refi cut. Might not actually be um, a pricing for a refi cut. It's just showing that because it's pricing in with extra liquidity coming into the system, into the banking system, the rates on the Euribor should be lower because there's more abundant liquidity. They don't actually have to have higher rates to attract people um, um, to get loans, essentially. So that's um, that's more or less the market pricing going. That was more or less the market pricing going into the event. Then we want to take a look at the statement signs. Very specifically, what do we see in the last one? Obviously, it's not as relevant for this meeting because the structure of it, if we do get a QE announcement, is going to be completely different to what we get before. But in any case, I think it's worth going through it because in most meetings, this is what we look at when we trade them. So when you trade the ECB, you normally get a statement like this, and you'll find Draghi opens up the statement talking. He always starts off, "Ladies and gentlemen, the Vice President and I are very pleased to welcome to the to a press conference," whatever he says there, and then he starts off. This is basically where he starts off when he's talking, and you'll hear it in the video when we're trading this again. You'll actually hear he always starts off the paragraph that makes the difference. He starts off, "Based on our regular economic and monetary analysis," and then he goes on to say, "In line with our forward guidance, we decided to keep the key ECB interest rates unchanged." Then the important line, "As regards our non-standard monetary policy measures, we have started purchasing covered bonds and asset-backed securities. These purchase programs will last for at least 2 years." And that's what he said in the previous December 4th, 2014 meeting. So the meeting before that, he announced, or 2 meetings before this one, he had announced that they were going to be buying asset-backed securities and covered bonds. Now he's basically telling us they've started purchasing them. This is, like I said, this is the most important bit that you want to pay attention to. Then they go through telling us next week we will conduct a second targeted long-term refinancing operation. That's like I said before, the TLTRO. Won't go through that now, but it's another liquidity measure for the banking system, to be followed by 6 further operations until June 2016. Taken together, our measures will have a sizable impact on our balance sheet, which is intended to move towards the dimensions it had at the beginning of 2012, which was 1 trillion. 1 trillion euro. So the balance sheet was at 1 trillion euros at the beginning of 2012, and they're basically saying they want to move towards that. And to do that, that's why the market's expecting a big package. In our coming months, our measures will further ease the monetary policy stance to more broadly support our forward guidance in the key ECB interest rates and reinforce the fact that there are significant increasing differences in the monetary policy cycle between major advanced economies. He's basically telling us there's a policy divergence between ECB and the FOMC. This is basically ECB, FOMC policy divergence. That's basically what he's saying there. However, the latest euro area macroeconomic projections indicate lower inflation accompanied by weaker real GDP growth and subdued monetary dynamics. In this context, early next year, the Governing Council will reassess. So early next year, the Governing will reassess the monetary stimulus achieved, the expansion of the balance sheet, and the outlook for price developments. So they're going to overlook everything, and they're going to make a decision on potentially doing some more QE. We will evaluate the broader impact recent oil price developments and medium-term inflation trends in the euro area. Here we go. This is another big line. Should it become necessary to further address risks to a prolonged period of low inflation, the Governing Council remains unanimous in its commitment to using additional unconventional instruments within its mandate. This would imply altering early next year the size, pace, and composition of our measures. So that was basically a punchy line, basically saying that they're going to look to do that if they feel as if they have to address the risk of too prolonged period of low inflation. They do not want low inflation for too long because, in that sense, that has the risk of deflation. So overall, this is the these three paragraphs. So we've got paragraph 1, we've got 2, and the third paragraph are usually the most important paragraphs. Usually, if nothing takes place in these three paragraphs, and then he starts saying the words, "Let me now explain our assessment in greater detail," that's usually where, if you come into a scenario where he hasn't acted, he hasn't done anything, he hasn't said anything new, this is where you usually look to sell either equities, bonds, and probably buy euros, buy the euro USD, because it's not necessarily hawkish, but not as dovish as expected. And that's usually the cue for traders when we're listening in and you hear, "Let me now explain," without anything said in these first three paragraphs. That's where we get involved at the "let me now explain." And that's traditionally where the flow has come into the market, where we've seen the flow come into the market. But probably won't be as relevant um, in this specific meeting. In any case, definitely something to keep an eye on and be aware of. Okay, the next bit is probably a very important bit. The market structure and looking at the most sensitive markets. So I've picked three markets: the Bund, the Euro Stocks, and the Euro USD. The Bund is one of my main markets. I trade all the time. The Euro Stocks is another one of my main markets. Euro USD is not one of my main markets. However, I do trade it if and when I have to. If we take a look just purely on the market structures, the Bund had been rallying quite aggressively, coming in to the day. This is the previous day. This is the previous day here. We had been rallying quite aggressively. You can see the price action is very aggressive. And on this day, just prior, we saw a very big offer. And if I remember correctly, there was very little structure in this area here. So theoretically, the next real structural area of resistance, if you were going to sell this, would come in this area here, because we had basically this double inside day. We had an inside day here, then another inside day here, and the market broke to the downside and caught out some positions. But this structure in here, sorry, getting a little bit messy here, but let's try and do this again. This structure in here is really our next real resistance in here, and specifically in here at these 157.53s. Our support from the previous day, we've got our low of the day, the previous day 156.61. We've got this low in here at 156.10. This was the opening day, the open of the day at 155.84. As I remember, this is where they basically announced that they would be looking into doing possible QE. So very important reference point for me, and if the market were to get down there, I would be looking to buy that area. So we've got support, support, support in these areas, and then further down, I'm not going to go through those areas, but in the near term, these are the areas I'm looking at specifically, and the high with the recent all-time highs at 157.97. Right. So let's move on to the Euro Stocks. And looking at the Euro Stocks, this was basically, if you look on a larger time frame and you pulled up the larger time frame, on the monthlies, we had done something. So we'd done something like this, where we'd come into this big area, trade it up in here, and we were kind of coiling in this little range in here, something like this. and we're basically looking at this segment in here. We're looking at something in this little region in here. So that effectively is something like that. And that recent high there was the 3282s. We've got this really important swing low and swing high area at 3212s. Quite a bit lower, but this is the previous day, as you can see in here. This was our S&B day, where the S&B removed the peg, and then the market started actually speculating. There's a reason why they're doing this, potentially for ECB QE, and that's where we saw these large moves in the equity markets higher. These are your real areas you want to be looking at: 3212s and 3282s. Looking to see if we can find more buyers above here. If we can and we get back below these 82s, I'm looking potentially for another move down. But let's just see. That's basically the structure what we're looking at. Let's just see how that pans out when we actually trade it. Okay, whoa there. That's zoomed out way too much. Just bear with me a second. There we go. So looking at the Euro USD now, effectively this is probably the one that's been trending the most. It's a very trendy market. You could see it had this very clear pennant formation in the dailies going back to 2014. This little false break, broke back inside, and then we started trending. This was the start of the year, and here we left a gap, and the market started trending lower. We had this little flag formation here, broke it, found some support at 114.67. We had an inside day in here 2 days ago at 116.46 and 115.47. So 115.47 you can see is very important support area. We've got double daily lows with a false break of that inside day to the high, to the upside, and then came right back in and closed inside. So that's technically quite bearish and a bit of a rejection area. So overall, this is screaming bearish and screaming a sell. So if there's any sort of larger than expected stimulus, I'm going to be looking to sell the euro. The bunds, as we went through before, a little bit of a hairy situation because it was very bullish, but we've got a very bearish candle. A little bit, I'd say, confusing. The Euro stocks looks quite firmly bullish. So in that case, the markets we probably want to trade are the euro and the euro stocks. So now we get to the most important bit, the juicy bit, which is the scenario analysis and the trade plan. And precisely what are we looking to trade and how are we looking to trade it. So we looked at the 3 different markets, and we're going to look at our scenarios. And the scenarios are as such, and I've split it up into very concise scenarios. We're basically looking at 2 things. We've mentioned size, and we want to know the risk sharing. Now, I've basically put it in categories of small size and low risk, large size, low risk, large size, large risk, small size, large risk. What I categorize as small size is going to be less than 500 billion. Larger size is closer to 1 trillion. For risk sharing, low risk sharing is risk sharing below 50% of the total size. And for high or large risk sharing is sharing of 50% and above. So risk sharing above 50% of the total size. So that's basically making it as simple as possible. There's 2 variables, and those 2 variables can be either high or low. And then I'm building my scenarios off that. I'm scenario bashing. This is what we call scenario bashing. And when you do scenario bashing, you're basically giving yourself the most number of scenarios so that you can trade this as quickly and as efficiently as possible. And this is, like I told you guys, you're going to spend probably 30% of your time building this so that you know exactly what you're doing when the announcement comes out, or if it doesn't. So let's look. As you can see, I've highlighted anything bearish in green, anything bearish in red, anything bullish in green. For Euro stocks, if we look at, let's just look at the first scenario, small size, low risk. So that's less than 500 billion and the risk sharing below 50%. I'm expecting the market reaction in the Euro stocks to be very bearish, versus the consensus expectations, and periphery should underperform. Reason being, we've already seen a very, very aggressive pricing in of QE, and we know that the market's already pretty much um, expecting it and waiting for it. If we don't get something bigger than 500 billion, it's less than 500 billion, plus the risk sharing is below 50%, I'm expecting the periphery to underperform, and I'm expecting the stocks to sell off. So what am I going to do? I'm going to hit full size short at market. And note how I actually write this out to myself. Full size short at market, scale after 20 to 30 ticks. And that's obviously very discretionary. That's probably something I've just noticed on these kind of announcements. You get the first flush of about 20 to 30 ticks, and then it probably does trend, but I like to take out the majority of my size on the first quick flush in the Euro stocks. And then I've also said hold some size short until close. So I'm willing to stay short until the close of the day. There could be some washbacks, but if I take most of my size off, let's say 3/4 of my size off, and I leave one clip on just for the rest of the day, I'm happy to do that because I've taken the majority of the move on some decent size. For the Bund, notice gray. It's a gray area because I'm not sure. It's not a black and white situation. So there's a possible bid on a back of risk off moves. Gray area. What does that mean? Don't trade this straight away. Wait for the price action to confirm of bid and then get involved. So I'm waiting for price action in this scenario. In other words, I'm passive. These are aggressive. I'm very aggressive in this situation. Euro. On this sort of thing, it should rally as it is a risk barometer and there's less liquidity. So if there's less liquidity, then has already been priced in. I'm expecting the euro to actually rally. However, note we have seen the structure is very bearish, so we could see a rally, but at some point someone might step in anyway. But that might be a lot later. I think after the scope of trading within the first couple of hours. So what I'm thinking is hit full size long at market and look to scale after 50 pips. That's my plan there. Again, looking at large size, low risk. Closer to 1 trillion, risk sharing below 50%. I think this is a bullish scenario for risk assets, so I expect a rally. I'm hitting 4 clips at market. I'm very specific about what I'm doing. I'm hitting 4 clips at market. Then I'm staying long, and I'm basically staying in this trade until they mention risk sharing. If I get 20 to 30 ticks on side before that, I'm scaling. So it's one or the other. If he mentions risk sharing and the risk sharing is below 50%, I'm basically starting to scale out. If I hit 20 to 30 ticks and I see price action that makes me want to get out, I'm scaling. If you see an offer at some point, I've also put this in, get involved tentatively with 2 clips and wait for price action confirmation. The only reason why I'm saying this is because even though we might get closer to 1 trillion mark, we've already seen quite aggressive pricing in. If we start seeing an offer because they feel as if the risk sharing is quite low, and the market's probably priced in some sort of risk sharing, maybe closer to 50%. If it's low, maybe in the region of 10 to 20%, well, in that case, there might be an offer coming in. So I'm telling myself, do expect a rally, but there could be an offer at some point. It could be an offer, so just wait and see on that one. Again, bunds. Gray area. Possible bid on the announcement QE. Gray area as inflation expectations may rise. Follow equities for risk sentiment. Don't trade this on announcement. Wait for risk sentiment in the equities and periphery. The Euro USD. Again, the converse to whatever the stocks is doing in a risk on scenario, and more stimulus liquidity or higher liquidity scenario, the euro should sell off. So I'm looking for a sell off due to a larger than expected size. And I'm telling myself, hit 2 clips of market and start to scale at 30 to 40 pips. Now, yes, the market does look relatively bearish, and yes, in the last one, I've actually said hit full size. Why have I said that? Yes, the market's bearish, but I also know that the market's positioned short. So in this case scenario, I'm more willing to hit full size quickly because I know those guys have to get out. So the shorts need to cover. So I'm willing to do larger size for quick moves. And this, even though this could trend, I'm going to hit 2 clips at market. It's not a very great risk sharing scenario, but 30 to 40 pips is decent for me. I'll concentrate more on the Euro stocks in this situation. If we move on to large risk, large size, large risk, this is probably the most bullish scenario for risk assets. In this scenario, I'm hitting full size at market. I'm not getting out until the close because if it's closer to 1 trillion and there's a lot of risk sharing, the periphery is going to outperform. It's going to be really strong. The market's going to be really happy with this, I'm assuming, and I'm expecting a rally straight into the close, just an overall rally that might just close literally on the high. So I'm willing to hit full size and hold that for the remainder of the day. Again, with the Bunds, initial bid, but spread plays could show off as periphery outperforms. So because there's a larger than expected periphery, maybe the BTPs outperform the Bunds, and so, spread players come in and start buying BTPs versus Bunds, so selling Bunds. It's a bit of a hairy situation. I don't want to trade this on the announcement, and I'm watching price action for clues. In this scenario, the euro should sell off heavily. So again, sell full size of market and don't get out till the close. You can see I'm very specific at what I'm looking for, and even though there's a lot of scenarios, if you make this matrix out yourself and you know exactly what you're looking for, yes, there's a lot of scenarios, but if you just keep bashing them into your head and you're discussing them and hitting these ideas off of other traders as well to see what they think, you know what you're doing. You're prepared, and when the price action presents itself, you won't be scared to hit it. Again, the last scenario: small size, large risk, less than 500 billion, risk sharing above. Yes, it's a bearish risk assets, but more positive for peripheral equities. So I'm still looking to sell 2-3 clips at market, but I'll probably cover the position after the large risk announcement. So if they tell us they're going to take larger than expected risk, I'm looking to scale out because there'll probably be a push higher just because the periphery is going to get a nice little jump on that. Same scenario again with the Bunds. Initially sell off, but could catch a bid as inflation expectations remain low. Now I'm looking at inflation expectations because even though they're doing it, and it could sell off because it's lower than expected, because there's a risk off theme, and because the market might think, well, wait, this might not actually increase inflation. If inflation expectations remain low, then maybe the Bunds might come off and then start rallying after that. So I'm saying don't trade and watch the periphery for clues of spread plays. For the euro, should rally initially and could maintain a risk off sentiment if risk off sentiment carries on. So I'm buying 2 to 3 clips at market on smaller QE. Cover all when large risk announcement is made. If I see the buyer stay strong, then I'm willing to follow the trend. So this is overall all the prep that I've done beforehand, all the reading, all the backdrop, the market pricing, the market structure. It all comes down to making a really solid scenario analysis. If your scenario analysis is solid and just robust, so you know exactly what you're doing, and if someone comes up to you on ECB day and asks you what you're going to do if there's a large size and low risk or large size and large risk scenario, what are you doing? You're probably going to say, I'm going to buy the Euro stocks full size, balls deep. I'm not getting out to the close. And likewise for the euro, I'm selling it full size, and I'm waiting for that to trend lower aggressively. You need to know these literally off by heart in the back of your head, so that when it comes out, you don't hesitate. You're not missing the first 10 to 15 ticks. You're first in at market. You're just hitting aggressively. And for the ones that you have to be passive, you can watch the price action and you already know, you have an idea of what you're expecting. If you don't see anything that you're expecting, you just don't trade it. And it's as simple as that, guys. Minimizing your risk, minimizing your decision making when it comes down to putting the trade on. So I hope after doing this analysis, everything's kind of come together. In the next video, I'm going to actually go through the trading event and what actually happened in the price action. We'll go through the scenario and how we could have executed. So thank you very much, guys, for listening. It's been a little bit longer than expected. But yeah, hopefully the next one will be a lot more fruitful with all the preparation. Bye-bye.